please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Interest rates seem to be in a flux. Oil prices are at multi-year highs and inflation seems to be rearing its head again. On the other hand, below than expected GST collections have given rise to worries about higher fiscal deficit. Now, all of this is usually not great news for the bond market, and you would have surely caught those recent headlines talking about surging bond yields. And that has been quite a story of 2017. The benchmark yield, which was at a low of 6.4% in July 2017, hit a high of 7.4% in December last year. That's an entire 100 basis points move. So, what does all of this mean for your fixed income investment? Do rising yields mean higher interest rates? What about your fixed deposits? What about your debt mutual funds? What is the safest bet to be in the fixed income world given all of this volatility around us? Well, we're dedicating this entire episode of Money, Money, Money to answering exactly those sort of questions. Joining me to get us those answers is the Managing Director of the country's largest PSU bank, Mr. P.K. Gupta of SBI. To give us a perspective from the debt mutual fund standpoint, I have with me Amit Tripathi, who is the CIO Fixed Investments at Reliance Mutual Fund, as well as Dwijendra Srivastava, who is the CIO Fixed Income at Sundaram Mutual. Gentlemen, thank you so much for taking out the time, and thanks very much for joining in. Now, Amit and Dwijendra, lots of questions because, this is the time when retail investors have really started looking at debt mutual funds. Everybody knows the fixed deposit 6% is not good enough. But before we start talking about that, let me actually get in the banker. Let's see what SBI's sort of outlook is on interest rates. So, Mr. Gupta, thanks very much for being with us on the show today. Let me get your first thoughts in. And the first question is a pretty simple one. There's a lot of talk, as we just sort of outlined, whether it's inflation, whether it's crude oil prices, fiscal deficits, and those yields are moving higher. What does that mean? What can we expect on interest rates this year?
No, I think as far as the interest rates direction is concerned, I think that the downward cycle in the interest rates is practically over. You look at the inflation, the CPI is at 4.88%. As you know that the RBI has been looking at 4% as their target CPI. Okay, so even though really, they talk about plus minus 2%, but I think really what they are targeting is 4% inflation. Given that as the objective of RBI, so we don't really see any downward movement in the interest rates happening. In the past, there has been a lot of liquidity in the market, which actually kept the interest rates low, in the bond market or in the general markets also. But a lot of that liquidity has since got used. But still there is some liquidity in the market. I think about 100,000 surplus is still there in the market, but most of this probably has now come on account of maybe the RBI's operations in the forex markets, where probably they have been mopping up some dollars from the market, and that is what the Deputy Governor Viral Acharya also indicated in the last monetary policy press conference also. So I think as long as that liquidity still exists, so we don't really think interest rates moving up actually. But I don't really see any downward movement in the interest rates happening anytime soon.
Okay. So, sir, does that mean that you are expecting a longish pause by the Reserve Bank of India? I mean, how long? What, the first half of 2018? That no move from the RBI?
Yes, I think I would believe that we would have longish pause, because I don't really think that the scenario as it exists as of now warrants an increase in the interest rates. So we are probably in for a longish period of pause on the interest rates. I think interest rates should remain stable around the current rate for quite some time now actually.
Okay. So then let me boil this down to your customers, the bank's customers and our viewers as well. What can borrowers expect with respect to, rates both on the borrowing side as well as the deposit side? So if there's a pause from the RBI, should we expect stability?
No, I don't really think that there should be too much of changes happening there also. See, we did cut our base rate effective 1st of January, but that was the cumulative effect of whatever the interest rate changes that the bank had made in the last quarter. So the impact of that got passed on. As far as the borrowers are concerned, I think if you look at the interest rates, they are probably at the lowest level, okay, as compared to many years in the past. So I think they should continue to take advantage of the low interest rate regime that exists. Will the interest rates move substantially higher from here? I think again probably it will not happen in the near term. The bond market and the bank, interest rates on the deposits and the lending side, I think we must look at it how they operate. So both these markets operate totally independently. So as the markets don't really expect RBI cutting rates further, so I think the bond market has corrected. So the overall yield curve, which had practically become flat, has now steepened a little bit. So as I don't expect a lot of movement happening on the interest rates on the deposit side, so I don't really think that the lending rates also will get changed.
Okay, so fair enough. Got your point. You're not expecting any kind of a major rate hike and stability on interest rates. But the fact is that FD rates are very, very low. And that has been prompting a big shift towards debt mutual funds. People really want better options, more tax efficient returns, higher returns. And that's a trend that we've begun to see. So your thoughts on the same?
No, I think we do believe that the customers must make use of all the investment options that are available. Okay, and even as a bank itself also, we have a lot of customers who have a lot of surplus money which lies with the bank. Okay, so the bank FDs do offer a lot of flexibility to the customers in terms of how they can use it whenever they need the money, they can draw it. But at the same time, particularly for the customers who are at the highest tax paying bracket, for them it does make sense to invest part of their portfolio into the mutual funds also. And even the debt mutual funds, actually with the indexation benefit that is available, does give a better yield to the investors as compared to the bank FDs also. So I mean, even though as a bank we probably end up losing some of the deposits, but I think we do advise customers to park some of their funds into the mutual funds also.
All right, Mr. Gupta, thanks so much for being with us and taking us through your expectations on which way interest rates are heading and what depositors and borrowers can expect from SBI and big banks like yourself as far as this year goes. Well, now let's take the conversation forward, and that's really the question. If you're willing to go beyond the fixed deposit, if you're looking at better returns, then how do you go about building your fixed income portfolio? Amit and Mr. Srivastava, that's really the central point, right? To try and understand that when you want to make that shift, looking at the flux in the market, Amit, where does one even start? I mean, is it important to first set your time horizon, whether it's 1 year or if it's 3 years, if you're looking at the tax advantage?
Yeah, I think tax advantage is definitely one of the bigger incentives, at least for first-time investors, to start looking at mutual funds. But I guess what one should really concentrate on is the efficiency of the investment per se, and obviously marry your investment to the time horizon that you're looking at in terms of whether it is 7 days, 1 year, 3 years, 5 years, whatever be the time horizon.
Absolutely.
So I guess picking the right product to match your time horizon actually removes a lot of the so-called risks that are associated with capital market instruments,
Sure.
Specifically with mutual funds. So if you have the time horizon right, we typically believe that a lot of investors will always exit with a very positive experience as far as their investments in mutual funds are concerned, debt mutual funds specifically.
Okay, so that's really rule number one, that
Yeah.
make sure that you know what is your time horizon, for what purpose do you want to park your funds, for how much time, and then the process of choice begins. Mr. Srivastava, let's get your thoughts on the market per se before we start talking about the sort of funds. You just heard one view from SBI. They're not expecting anything dramatic from the RBI, not even a rate hike, as the market, though the market seems to be worried. What is your own reading?
So I think I would agree with the SBI in terms of the fact that there could be a longish pause before RBI actually moves on the rates, and probably the movement should be on the upward side. When we look at, we have to put things in context of both domestic as well as global factors.
Sure. So, Amit, your reading on this, just purely the rate cycle. Is there a hike coming? If yes, by when do you think we'll see that?
So if you look at market pricing in total, so 3 or 4 points. One, market is definitely not looking for any rate cuts in 2018. Market is fearing rate hikes in case the commodity cycle, especially oil prices, continue, and it puts pressure on core inflation going forward. Market is also expecting a very buoyant growth cycle to continue globally and India to catch up in 2018. And somewhere around the line, even for developed market economies, market is expecting inflation to catch up, right? So whatever we have seen in the market in terms of movement is a combination of all these factors coming in terms of yields. Sure. And hence there is some discounting of that fact that if there is a deterioration in macro fundamentals, whether it is on inflation or fiscal deficit side, then there would be chances of rate hike sometime towards end of 2018 or
calendar year 18.
Yeah, calendar year 18 or thereabouts.
Okay. So the fact remains that at some point in time in calendar year 2018, we might look at a rate hike from the Reserve Bank of India, something which the bond market is already pricing in. This is a fixed income special. If you want to figure out what's happening to interest rates and what that might mean for your debt investments, then just stay glued to your screens and to your seats. Amit, generally speaking, anytime yields are rising, obviously bond prices fall. We all know about that inverse correlation. So typically, rising interest rates is not good news for the bond markets. Should we interpret it that way? Or if I were to flip the question around, in this environment, when eventually rates are going to go up, what sort of funds do well?
So, like we discussed Surabhi earlier, that as long as you have your investment horizon in sync with the product profile, really the amount of capital gains or capital losses that happen over a period of time get kind of neutralized. Okay. Having said that, in a scenario where yields are volatile in a range and are likely to be in a range going forward, it's always advised to be in a neutral duration product. When we say neutral duration, you're typically talking about products which would run a duration of around 2 to 3 years. Okay. The benefit of that is that a large part of your total returns would come from the carry element, which is the coupon or the yield itself, and a very little residual amount would be accounted for by capital gains or capital losses. Okay. Assuming that you stay invested for a period of 12 to 18 months and beyond.
Okay.
Yeah.
Okay. So let's just take a step back and go over the the time periods. So obviously, if you're looking at only 6 months or less than a year, then I'm guessing ultra short-term funds, that will be the the pick. In which case, Mr. Srivastava, what kind of returns can investors expect in these products for the next 1 year?
Typically, as Amit has already highlighted, that I think it is very important to understand your horizon. If you are less than a year, then typically what you are trying to do is you are trying to target something like repo rate plus something. So repo rate plus maybe 20-30 basis point in today's environment is what you will get it from a liquid fund, and probably about another 30-40 basis point in a ultra short category. So that's what you will probably be getting delivered in a less than a year kind of horizon.
Which is not incredibly higher than what an FD would be yielding you today, correct?
No, FD is yielding you about 6%, and about most of the banks, means I think about 80% of the banks.
6.25,
6.25
maximum, yeah.
So you will getting around 25-30 basis point more than what you are going to get from a FD, and on a tax efficient basis. Okay. If you hold your investment for about 3 years. Okay.
So now let's, if we increase the horizon, as you mentioned, if it's 18 to, sort of 24 months or maybe even 36 months, then should you go for primarily bond funds, which are primarily holding government securities? What sort of a mix can one look at?
So I would say a large part of your allocation still has to continue to neutral duration products of 2 to 3 years. There could be enough variance there, so people could look at high-grade products such as short-term bond funds, which typically invest more into the AAA space. One could also look at the accrual funds, which will give you a better carry and operate in the same duration space of 2 to 3 years. So a large part, I would say 75 to 80% of your allocations today in the current environment should go into these two type of products if you're looking at 18 to 36 months.
Either short-term bond funds or
accrual funds. Okay. A 20 to 25% allocation can continue to be in dynamic bond fund kind of products.
If you invest in a dynamic bond fund with a horizon of 2.5, 3 years, is there an interest rate risk that you're taking? What should you keep in mind then?
So one thing that you need to keep in mind very clearly whenever you invest in any duration product is volatility. I think what a lot of us tend to miss out is the fact that we tend to always react to short-term movements in our returns or short-term impact in our returns and tend to extrapolate it, right? So you as an investor, once you have decided on your time horizon, then you actually don't time it beyond a point and say that if I invest today, I do X, if I invest tomorrow, I do Y. Like you rightly said, as long as your time horizon is 2 to 3 years and beyond, then only this allocation of 20-25% makes sense. Otherwise, you stick only to short-term bond funds and accrual products.
Okay, fair enough. Your thoughts on some of these instruments, if you're looking at 2 years plus then?
So, one of the important thing which Amit mentioned, I think I would re-emphasize on that is, clearly the point is that holding horizon matters a lot.
Okay.
And that is what you need to understand in a fixed income instrument or fixed income, underlying fixed income portfolio.
You know, I'm going to take a break on that note and in fact discuss this, that if your agenda, let's say you have so much of surplus money that, you know, you can choose time horizon depending on what might give you the best yield or where you might earn the best return in fixed income. And this week we are talking all about debt mutual funds, fixed income investing. What do you need to keep in mind as 2018 rolls on and as these interest rates continue to be fairly volatile? Amit, so I'm going to flip the question around. I completely understood your point that if, okay, first you need to set your time horizon, but there are a lot of people who have surplus money on the side. I mean, the same people who are doing FDs because they don't know what else to do and they don't want to put all money in equities. So there's surplus money. It's not required in the next 6 months. It's not required maybe the next 1 or 2 years as well. For this category of people, which funds would you go with now?
Okay, I completely agree with you, because most of the times the error that I've seen investors making is actually they really don't know the kind of time horizon that they are coming in with. Okay, and you always tend to underachieve because of that. You know, you might have 1 year money and 2 year money lying in a liquid fund kind of a product, and in an ultra short term fund kind of a product, because people just think about it as temporary surpluses, don't really plan for it, and that money keeps on lying along, and you know, it's a suboptimal kind of a return. So if you are not very sure of your time horizon, and you know, but it could be 6 months, 12 months, 18 months, 24 months, the least that you can do is at least come into a neutral duration kind of product and not be very, very short in terms of duration, because there is an element of reinvestment risk, there is an element of carry in a steep yield curve. You tend to miss out on both in case you are making that mistake.
So explain what do you exactly mean when you say neutral duration, and which particular funds would, let's say from your stable, from your universe, which funds would fall under this category of neutral duration?
So a short-term bond fund would fall in that category.
Okay.
Accrual fund would typically fall in that category. These are products which typically, not only for us, but industry-wide, these would typically be running a duration profile of between 1.5 to 3.5 years, ballpark.
And Dwijendra, your thoughts on this? For someone who doesn't have a particular time frame in mind, has extra cash, is willing to invest as long as he gets good returns.
I think if they are comfortable with, so accrual also is construed as lower credit typically. Okay, so if you are, so another point of view, when I spoke about liquid fund return at 30 base point and ultra short at around 30-40 more from there, it was a high grade, high quality product. But if you're talking about, if you're comfortable with credit and you're comfortable with the fund house, the way they do credit, I think accrual funds in shorter duration also serve very well for an investor. And they give you almost about 100 basis point more than what a typical ultra short term fund can deliver.
So if in today's environment, if you're talking about a normal accrual fund, what should we expect? 7.5?
This could be easily about taking the volatility also into account. 7.5 is something which it can deliver in about a year's time.
1 year, you know, average return of
average in 6 months to 1 year.
6 months to 1 year. Similarly, for the short-term bond funds that we discussed, what would be the average, you know, realistic return expectation be?
So investors, if they stay for 1 year and beyond, should typically expect at least 50 to 75 basis points over what a liquid fund would earn.
Okay, gentlemen. So now, as we come down to final thoughts, I'm going to ask you know, each of you to pick out from your gamut of funds, and you know, you manage so many of them. You at Reliance and you at Sundaram. The 2 or 3 funds, if you were to park your own money, or if you were to, you know, tell me to invest my money, then which are the 1 or 2 or 3 funds from your own stable that you would go with as we look at 2018?
So, from a high quality perspective, in the short-term category fund, we have Sundaram Select Debt Fund, which I would recommend. It has done pretty well, and going forward also the idea is to manage the interest rate cycles there. Manage it from the interest rate side rather than from the credit side. While on the other spectrum, we have in the ultra short category a little bit higher accrual fund, which is Sundaram Income Plus Fund, which I would recommend people to hold these 2 funds in this kind of environment at this point. Probably we will revisit again as the interest rate environment changes.
Absolutely. Yeah. Okay, fair enough. Amit, same question to you. So you have a galaxy of funds. Looking at the market, looking at the environment right now, if you were to advise me or put your own money, then where would it go?
So if you have money, so be for less than 6 months, stay invested in Reliance Money Manager Fund,
okay,
which is an ultra short-term category product. If you have money for 1 year and beyond, the two funds which would work best in the environment would be Reliance Regular Savings Fund Debt,
okay,
and Reliance Corporate Bond Fund.
So Reliance Regular Savings Fund, what sort of paper does it hold? What's the mix there?
So typically it invests across private sector credits,
okay,
across the rating profile, and has a discipline of running duration of 2 years or below at all points in time.
Okay.
So it's a typical carry-oriented product. Corporate bond fund invests across private sector credits, but there we have a restriction in terms of not going too low in terms of the risk profile. Typically would invest more into the AAA and AA space. Benefits more from improvements in corporate balance sheets, cyclical upturns in the economy, and also in that sense gets a lot of help through spread compressions.
And as an aware investor and not a greedy one, what should be my return expectation, let's say from the corporate fund?
So in the current environment of interest rates, irrespective of which fund you are looking at, I don't think investors should be expecting more than 7.5% to 8% return over a 3-year kind of a time horizon.
This is including the tax efficiency, or no?
No. I'm talking about
just the fund return.
Yeah, post-expense returns.
Okay.
And if you are talking about shorter time horizon, then you have to bring down your return expectations a bit.
Okay. All right, gentlemen, very helpful conversation. Thank you so much for taking out the time and enlightening and educating our viewers on how to go about building their fixed income portfolios. Thanks very much. We wish both of you a great 2018 as well. That's it on this episode of Money, Money, Money. Your feedback, comments, queries are welcome as always. We'll see you again next week.